What is up, everybody? This is Stock Market Education, and today we're going to go over how to read a balance sheet the right way. If you want to own a business, the balance sheet is important to understand, and if you want to pick individual stocks, then the balance sheet is extremely important to read. We're going to take a look at Google's balance sheet because I want to look at Google's balance sheet. By the way, to get to the balance sheet, I just go on to Yahoo Finance and then type in Google because that's the company we're going to be looking at. And then you have all of these tabs, and then you click on the financial tab, and then you have three different choices: income statement, balance sheet, and cash flow. And right now we're going to be looking at the balance sheet. So you can see that they have 4 years here: 16, 17, 18, and 19. And then you can also see that they have a breakdown of assets. If you scroll down a little more, you can see that they have liabilities, and then even more, you'll see that they have equity. And one more thing to note in this. So all numbers is in thousands. So although this looks like 18 million, this is in thousands, so it should be 18 billion, which is a common mistake. And the first thing that I like to do is I'll compare cash and cash equivalents with any long-term debt that they have. So when you look at Google's cash and cash equivalents, they have 18.5 billion in cash and cash equivalents, and then compare it to the next best thing, which is accounts payable of $5.5 billion. When you divide cash by accounts payable, it gives you a number, and the number is 3.3. And what does this number mean? This number is pretty much saying that they can pay off their accounts payable 3 times over with the cash that they have on hand right now. And this is also important because this is an indicator showing the stability of the company over a long period of time. So let's just imagine, what if the coronavirus continues to slow down global growth and then sends us into a recession? Google is going to be okay because of how much cash they have. They're going to be able to ride it out. And that's why the metric is really important. In other words, it tells you how financially stable the company is. So that is cash and cash equivalents. So let's move on. Short-term investments. So short-term investments could include CDs, money market accounts, treasury bills, any type of thing that is a short-term investment. And then when you go down, you see a ledger that says net receivables. And what the is a net receivable? A net receivable is anything sold, but the money hasn't come in yet. Google is owed $25 billion in net receivables. And then if you look down at the next ledger, you can see inventory. And inventory is what they have on hand. And Google has a small amount of inventory because they're so good at turning it over. And then if we look at the next ledger, it says other current assets. And other current assets can include anything from prepaid expenses to additional cash and accounts receivables. So if we look down at the next one, it says gross property, plant, and equipment. And that one's pretty self-explanatory. I'm not going to get into that one too much because I don't want to. And then right below that one is accumulated depreciation, which is the depreciation accumulated throughout all the assets. So for example, if you have a building and the building's value is decreasing, then you would add that however much it's decreasing to accumulated depreciation. And this one is equity and other investments, and this one's another miscellaneous one. Goodwill is pretty much the value of the brand that they have, and they could pretty much put almost any number that they want to on this ledger. It's pretty flexible. And then the next ledger that they have is intangible assets. These are assets that you can't touch, like contracts, copyrights, trademarks, all that other stuff. Other long-term assets, this one can include buildings, machinery, stocks and bonds, all that kind of stuff. And then if you add all of these up, all of these assets up, you get this number of 275 billion, almost 276 billion. And that's how many assets that Google has. So now let's look down at the liabilities. And the first line that you see here is the accounts payable at 5.5 billion. And the accounts payable is pretty much bills. It's the short-term debt that Google has to pay off. And once you look down at the next line, you can see taxes payable, which is short-term taxes that Google needs to pay off. And then below that one is accrued liabilities. And accrued liabilities could be payroll or pension liabilities. And the next line you see is deferred revenue. And you're probably thinking, why is revenue on the balance sheet underneath liabilities? Shouldn't it be under the income statement? And yes, it should. However, deferred revenues is revenues received in advance for services And that's why you have it as a liability. And then other current liabilities is a subset of accounts payable. It's the same thing, short-term debt. And then when you look further down, you can see long-term debt. And long-term debt is loans, capital leases, pension liabilities, anything of that sort. And they have $4.5 billion worth of long-term debt. And then the next thing that they have is deferred taxes liability, which is just more taxes for long-term. Deferred revenues, so they have deferred revenues in two parts of their balance sheet. And then other long-term liabilities, and this is just another subset for long-term debt. And when you add up all of these liabilities, you get this number down here for total liabilities of $74.4 billion. And when you take the total number of assets and you divide it by the total number of liabilities, you get 3.7. And this is the debt to asset ratio. And generally what you want is as high a number as possible. 3.7 is a pretty high debt to asset ratio. And the reason why you want to have a high ratio number is because it shows for every $1 worth of liabilities, you have $3.70 worth of assets. And one more thing, if the debt to asset ratio is over 0.5, then that means that the company is financing through debt, and if the number is below 0.5, that means that the company is financing through equity. And if you look down even further, you can see common stock, and common stock is pretty much stock from the company that's issued. Retained earnings, it's in the name, earnings that have been retained for the quarter, year, however much they want to go by. And that is what all the lines mean in the balance sheet. And that is what all the lines mean in the balance sheet. That's it. Bye.